Welcome back, everyone. Today we're going to be talking about Lockheed Martin. We're going to be doing an analysis in a DCF model. All right, so the first thing I like to do when looking at a company is to just get kind of a baseline idea of whether they're cheap or not and look at their PE ratio. Now, typically I like to see a PE ratio 20 or under. However, higher PE ratios can be justified if it's a faster growing company. Lockheed Martin isn't exactly in super growth mode or anything, so you'd expect to see this under 20 if it's going to be anywhere near a good deal. And the PE ratio comes in at a 17. So we're looking good so far. Now the next thing we want to do is make sure that the company is growing over the last 5 years. In order to do that, we're going to look at revenue growth, net income growth, and free cash flow growth. Now I have all three of those up on the screen here, and you can see that on all accounts, Lockheed Martin has grown over the last 5 years. Okay, so next we want to look at their debt and make sure that they're affording all of that within reason. So what I like to do is take the 5-year average free cash flow, multiply that by 3, and then make sure that that amount is higher than their current long-term liabilities. So the 5-year average free cash flow multiplied by 3 is roughly $16.26 billion. So now we have to make sure that the long-term liabilities are under that amount. And indeed, they are under that amount at $11.66 billion. The last thing I like to look at is the current ratio. All that is current assets divided by current liabilities. In other words, if the company were to liquidate today, could all the current assets cover those current liabilities? Now, any number over 1 means that they can cover the liabilities, but when it comes to current ratio, I like to see that it's closer to 2, so let's go ahead and take a look. In this case, it comes out to a 1.4. Again, I like to see it closer to a 2, but technically over 1 is fine. Okay, so last but not least, we're going to go ahead and check out the DCF model. Now real quick, it was kind of difficult to come to a decision on this 3% revenue growth rate. Yahoo Finance has them growing at about 8% over the next 5 years as an average, and to me that sounded a little high. I looked at the last 5 years of growth based on a compound annual growth rate, and it was at 6%. But at the same time, all the analysts actually have Lockheed Martin having a lower year in 2022 than they did in 2021 for revenue. For example, Charles Schwab has them decreasing by 1.37% compared to the year 2021. It could be a one-off year that they're expecting that because most analysts seem to think on the whole it's going to grow over the next 5 years at a fair rate. Still, all those things considered, I wanted to play it safe, so I went with 3%. So based on the year 2021, we grow the revenue out by 3% each year, and at the year 2026, we end up at about $77.7 billion in revenue. Now we needed to project net income based off of revenue. We use 8% margins. And for reference, we get this net income margin of 8% by taking the last 5 years of net income and dividing it by the last 5 years of revenue. Now, it was 8.7% on average for the last 5 years, but I brought it down to 8% just to try to keep things conservative. After that, we want to project free cash flow from net income, and I used 1.8% to project free cash flow from net income. I got this from the last 10 years of free cash flow divided by the last 10 years of net income and averaged them all out, and it came out to 1.8%. Again, remember when we're doing this margin, we want to do free cash flow divided by net income. So we project all of those out based on 1.8%. We calculated terminal value based on the last year projected free cash flow, as well as a weighted average cost of capital of 6.3% and a perpetual growth rate of 2.5%. Then we had to discount all of those by whatever discount rate you want to use. I always like to use 12%. Remember, you should never go too much lower than that because honestly, you could always invest in an index fund or ETF, and on average, they can get you anywhere from 8 to 10%. So make it worth your while if you're putting the work in. I like to do 12%. After discounting all those figures, we then add all of them up, and we divide by the shares outstanding to get an intrinsic value of 434.33, or roughly $434 as our fair value. Okay, everyone, so we've run our DCF model, and according to the model, the fair value is about $434. The last price I saw on Lockheed Martin was about $385. So according to the model we ran, they're about 11.3% undervalued. Now overall, I think we were fairly conservative with the metrics we used. So if you believe this can grow at 3% over the next 5 years, the model suggests that this is a buy. Okay, so we're going to be wrapping this video up. If you feel that this content added value to your day, go ahead and give the video a thumbs up and subscribe if you want similar content. For now, that's going to wrap everything up, and everyone, you have a great day.